Hello, and welcome to today's Alpha Beta Series webinar, Agriculture ETFs. I'm Allison Jones, Director of Conferences for IndexUniverse, and I'll be your host for today's webinar. We're pleased to be joined on the call today by Sal Gilbertie, President and Founder of Teucrium Trading, and Sam Halpert, Senior Analyst at VanEck Securities. Both gentlemen will be joining us later on for presentations as well as for Q&A. We'll also be joined by two of our very own experts, Dave Nadig, Director of Research for IndexUniverse, and Dennis Hudachek, ETF Analyst, also here at IndexUniverse. This is the latest in our monthly series of webinars we are dubbing the Alpha Beta Series. For these webinars, we aim to provide complete 360-degree analysis of how to invest in different asset classes using ETFs. The format today is very straightforward. Sal will begin the conversation, and then we will move directly on to Sal and Sam, will kick things off with 20-30-minute presentation to discuss the agricultural market and where they see the sector going. Following their presentation, Dave and Dennis will cover various approaches to investing in agriculture ETFs, and will cover the beta portion of this Alpha Beta webinar. We'll end by bringing Sam and Sal back and having an in-depth roundtable-style Q&A on the topic of agricultural investing. As a participant in this webinar, you can enter questions for any of the panelists by using the Q&A tool on the lower right-hand portion of your webinar screen. Please don't wait until the end to ask questions. Submit them as they occur to you. We'll collate those questions submitted throughout the webinar and answer as many as we can before we end. I'd also like to point out that CE credits are also available for those attending the live presentation, and you will receive an email in a day or two with information regarding self-submission for those CE credits. At that time, you'll also receive a link to a recording of the webinar and a download of the slides that will be presented. With that, I'd like to hand it over to Sal of Teucrium. Sal?
Thanks very much, Allison. I'll try to keep it to 10 minutes. You said 20 to 30, so we can stay on time here and have plenty of time for questions at the end. First slide, disclosures and disclaimers necessary. The rest of the presentation will be a touch more interesting. That said, many commodities-based ETFs are 33 Act companies. They are not 40 Act companies. You do not have the same protections, and so especially commodities, they're very volatile, comes with opportunity and risk. So we encourage everyone to read the appropriate materials that go with each fund, a Teucrium fund or not, before you invest. So now we'll go to the meat of the presentation. This first slide, and what I'll do is go over the content of the slide and then give you my assessment of a quick takeaway at the end before I ask for the next slide. Essentially here we're talking about futures-based ETPs versus either securities-based ETPs or ETNs. Obviously, securities-based ETPs will be covered later on, and they're very valuable, especially for commodity sector value chain capture, depending upon your view of commodities. But if you really want a bet on the underlying commodities, a direct exposure, you need to invest in a futures-based ETP that's not metals. Metals hold the physical commodity. So, bottom line, first thing to look at in these ETPs is transparency. And a key difference, and I know it'll be covered later, but are ETNs versus ETPs. And ETPs are ETF-like instruments. The regulators would like us to say ETPs. ETN is a credit instrument. It's basically it goes on the debt side of your holdings in your portfolio. Investors are unsecured, and there's really no visibility. The issuer may or may not be hedged on the underlying. Now you can make the assumption that they are, but you simply can't see it. So there's no transparency there. An ETF-like structure, an ETP, is a collateralized instrument via its legal structure. They're generally a partnership or a trust, much like the SPDR, and so they have very visible holdings, and the investor actually owns a piece of them. So it's collateralized. The investor has a piece of it. There is little or no actually credit risk to the actual investor. Websites for ETPs are updated by the issuers daily, not just Teucrium. You can see what activity happened that day and what exactly are in the funds. ETPs are extremely liquid. There's no way to describe how liquid they are. I think if you understand how they're priced, there's a bid ask in the ETP and the New York Stock Exchange, generally where these things are listed, where all the Teucrium products are listed, and most ETPs are commodities-based ETPs. A bid ask is generated by arbitrageurs who are professional. That's what they do. They provide liquidity based upon the underlying. So, for instance, in the corn pits, the corn futures pits, when they're open, and they're only open 3 hours and 45 minutes a day, on some days, $10 to $12 billion of corn is traded. So any commodity-based exchange-traded product that has corn in it, there's no size stock order that anyone can put in there that's going to move the market. These things are incredibly liquid. The hint there is trade them while the underlyings are open. The true measure of liquidity for any ETP is the number of shares authorized. It's not current volume, average volume. It's not number of shares outstanding, because through nuances here, the arbitrageurs can create as many shares as are needed. The broker-dealers are given an exemption. It's 6 days long before they have to come up with the shorts. So you can create as many shares as you like with these. Just put your order in and buy them. That's a very important distinction. You can buy any commodities-based ETP, as much volume as you like, if you trade while the underlying is open, because it's an arbitrage product, so the liquidity is instantly available. If you don't have the availability of a liquidity desk, there are desks out there on the street, and you can, if you're a big trader, you can have direct access to them. If not, ask your platform provider to go to a liquidity provider, people who provide blocks of 50,000, 100,000, million share blocks at the price you see on the screen, or just use the IIV, the indicative value of an ETP. Okay, so the next thing to look at is exposure to the futures pricing curve, and that's closely connected with contango and backwardation. What you want is everything in the box is important. If your investment horizon is 30 days or less, first-generation exchange-traded products that concentrate in a single month, generally near the spot or spot months, those are easily traded, very easy to trade in and out of, and they move very quickly with the commodity. If you're an investor versus a speculator, so your investment time horizon may be more than 30 days, let's say, you want to look at a product that's a next generation, has exposure to the futures pricing curve. And what that does is mitigate contango. Contango is where a futures contract that has to be sold by the fund and then replaced so that you don't go to delivery is more expensive, so you actually own less of them. That's a very common situation in commodities. It's a natural state. It can harm you and it can help you. There's no way to tell what it is. So go for a fund that looks to strip out contango and backwardation. And backwardation is the opposite of contango. It's just backwards. So the takeaway from this slide is that ETFs are highly liquid. They're transparent. Choose your product according to your investing or speculative needs. So the next slide, we basically here very quickly, if you look at inserting commodities into your portfolio, and this is direct exposure to commodities, look at those little boxes on the bottom. The returns are extremely similar. They're actually slightly better, marginally better if you include commodities, and the risk drops significantly on a percentage basis. So including commodities in a portfolio not only now is widely accepted, the key takeaway from this slide is look at the size of the commodities allocation that helps your portfolio, 32%. That's enormous. So the question all investors and advisors need to ask themselves is, do I have enough commodities in my portfolio, enough of an allocation there? The next slide, again, keeping on the asset allocation theme, if you notice that three of these are broad-based commodity indices, and many people own an index already to get some commodity exposure, we would posit that people are underinvested in commodities based on the previous slide, 32%. And another key takeaway here is that, again, almost everyone has exposure to broad-based indices in commodities. Number one, do you have enough? Number two, you're likely overweight energies. Almost everyone overweights energies. What's amazing to us here at Teucrium is that people aren't overweight in the ag space. So agriculturals have a really big place in a person's portfolio. They are the last two things that people will stop using, regardless of what is happening in the global economy. People don't want to be hungry. They don't want to be cold. So if you look at the big four, corn, wheat, soybeans, and sugar, the exposure here on the broad-based commodities indexes is about 18% average if you just eyeball it. So, 18% of 32%, you need somewhere between 5-6%. According to these are not recommendations, they're just what's out there, of your portfolio allocated into the big four agricultural products. So on to the next slide. Why is it so important to have these agricultural products? Commodities are based on supply and demand, and we have a staggering increasing demand for agricultural commodities. And the chart on the upper right of this picture is middle class. Middle class, I believe this is as defined by the World Bank. It's just growing so rapidly, and in China it's parabolic. It's just unbelievable what's happening there. And we as Americans have taught people to use a lot of stuff. So this expanding middle class, this U.S. equivalent of a middle class, they're just beginning to use things. And of course, energy and agricultural demand is going to increase there. More people equals higher demand. There's less arable land. That's something you need to keep in mind. Land is of limited supply. The human population is not. So in theory, we have an unlimited demand chasing after what always has to be each year a limited supply of production for crops. And that brings an important point. Crops must be replaced every year. Nothing grows in the winter. If you have a crop failure, the world has to endure it. If there's an energy crisis or a mining problem, there are known extraction rates from natural gas and crude oil wells, from gold mines, from palladium mines. If a crop doesn't grow one year, you have a failure, or just a less crop grew than was expected, everybody has to wait, and the demand does not subside. People are going to continue eating. And that's one of the reasons why people really need to be looking at agricultures in their portfolio, and they need to look at, as per the theme of this conference, alpha. Your beta exposure is there in your general commodities index. You need to increase it or decrease it as your opinion may be, and you can do that very easily with these ETP products. One thing about the increase in the middle class is the first thing they do, and there are studies that prove it, is they increase their intake of protein. And that means animals, which are fed by grains, and obviously some high protein grains. They also increase their consumption of sugar. And that happens before they buy a car. So, we like to say here at Teucrium, corn is the canary in the platinum and palladium mines. A lot of people piled into these precious metals that say go into the catalytic converter of a car. Automobiles are the last thing a person buys with their affluence, with their newly found affluence. The first thing they do is increase the protein in their diet. And so grain and sugar consumption does go up. So that's something to keep in mind. To the next slide. This slide is actually the takeaway points for the last slide. When almost everybody's overweight energies, as we said, but when we at Teucrium see a petroleum station, we don't think energy, we think ags, and in particular corn. And so, the standard example is if you pull an automobile SUV size up to a petrol station, you're going to use the rough equivalent of a bushel of corn when you fill up. That's what you're doing because of ethanol production. Now, when you walk into that store because you're hungry and you get something to eat, if it's a chicken taco or beef jerky stick or something, there's corn's #1 use throughout the globe, animal feed. #2 use throughout the globe is ethanol, and actually the past 2 quarters has been the #1 use in America. We'll get to that. You get something to drink. It's sweetened with corn syrup. You're taking notes on this webinar, hopefully, and the paper that you're writing on is held together with cornstarch. If we talk too much and give you a headache, you're going to pop open some pain relievers, and the little plastic safety seal on that bottle is made with corn polymer. So you use so much corn in your everyday life, and people think about energy. Everybody knows they're using energy. They absolutely have no idea that they're using that much corn, and it's not just corn. Let's go to the next slide. And here's where ags really need some alpha products, and hopefully we and others are providing those for investors. Think about if you could overlay arrows, if we were sophisticated enough on this particular slide to have pop-up arrows. Look at corn and livestock feed. Well, guess what? You can point an arrow over to wheat, because when corn and wheat are the same price, wheat has higher protein content. An animal feeder will switch to wheat. That's what he wants to do. You can put an arrow from corn and wheat over to soybeans, because soy meal is used for animal feed. So those three things are big in animal feed. Go to corn's worldwide second use, ethanol and gasoline oxygenation. Okay, corn is a fuel. Guess what? Sugar makes ethanol. So you can have an arrow going from corn to sugar. There's a wheat-based ethanol plant in the UK. There's a wheat-based ethanol plant in the United States. Put an arrow from sugar and corn over to wheat. They're all connected. Any problem with any one of these commodities can result in a ripple effect with the other. Look at biofuels. So point all the arrows at soybeans, because soybeans obviously are a key ingredient in methyl esters besides palm oil, and so your biodiesel all originates from soybeans. So these things are so connected that a problem in one, and again, crop problems, they're not just they're not just Bible stories. We like to say that floods, famine, pestilence, all this stuff is real to a farmer, to every farmer around the globe, including in the U.S. And there's a reason why grains are a defensive play. They're interrelated, and they're interrelated in the economy. And your major analysts, every time you turn on the TV or read a newspaper, you hear Jim Rogers or Dennis Gartman or somebody from J.P. Morgan or Morgan Stanley or Wells Fargo telling people to overweight grains, even if they're just a defensive play. So there's your alpha bit of critical mass here for alpha products. On the next slide, we'll get specific. This is a very unique slide in that our friends at New Edge provided this for us, and they have done a seasonality study. And this is simply a price divergence from the average price for the year. That this happens to be a corn slide. And if you look at the blue line, which is the bulk of, it's a 15-year line, 16-year line, you can see that you negatively diverge basically August through December. And there's a little dip in December, which is really interesting, because in corn, what this means, first off, negative divergence. If you're layering into your portfolio, putting a core holding in, what you want is to pick your spots to put your core holding of grains in your portfolio, or to increase from your beta holding in your general commodities index to your alpha, to over allocate to grains, which is what more and more people are shifting to. December in corn not only has the traditionally lowest divergence from average, so it's a great time to layer in. 5 of the last 22 years, the low price for corn a year out has set a bottom in December. So we are in the midst of a fourth quarter seasonal that is really dramatic. Corn in and of itself, we have a seasonal study that we've done. 20 of the last 22 years, corn has put a bottom in the last half of the year. And again, 5 of those times were in December. So it's really, really critical to understand there's seasonality involved with grains that can be taken advantage of, especially with alpha products. So next slide. Just happens to be soybeans, and it's got the same pattern. They're harvested at the same time of year. Soybean bottoms on the seasonal variance a little earlier, but it's just an example that there are seasonal patterns that an investor can use to assist them in layering in not only their core holding, but in overweighting during alpha period. Then underweighting, where you see the tops. Next slide, just to have them up there to cover the big 4. We have sugar. Again, these are, sugar's grown in the opposite hemisphere as corn and beans, and so you have a bit of an oppositeness in the year. So March through June, you put in your lows. Last slide is the wheat seasonal, and again, due to winter and spring wheat harvests, April and May, and through actually, the spring, April through July is the time you get those lows. And again, at your traditional soft wheat growth period, which is same time as corn and beans, that happens in December. So the key takeaways here and conclusions from this presentation are that agricultural futures-based ETFs are highly liquid. They're very transparent, easily tradable. They're a defensive play, and there are seasonal patterns that investors can take advantage of. And just as an aside, I know people will get to it later, but correlation of commodities, especially of grains, it seems to be less, statistically far less, with the stock market than of companies, the securities of companies who are participating in the grains market. So alpha for ags is possible, and it's a good, vital and defensive sector. So I'll turn it over to Sam Halpert right now for his part of the presentation.
Thanks, Sal. I'm going to talk more about what's going on in markets. This is actually our ETF. I'm on the active side, so I don't have to do anything, but I think it's a reasonable representation of the ag equity universe. And so if you go to the next slide, what I think is interesting to note is when you're buying, and this just lists several different ag equities. So Mosaic is number 11. It's a fertilizer company. Agrium is number 12, SQM is a fertilizer company. Agrium's diversified in retail and fertilizer. Number 14 is Intrepid. Monsanto, this is a list of sort of some normal names. Then you've got some protein names down at the end, an ethanol producer in Green Plains, ADM, a processor. Lindsay is a irrigation equipment manufacturer. So quite a diverse universe here. And then we've also got soy and corn in the middle, sort of lower part there. But the point is that when you're investing in these names, you're getting a play on ags, and I'll go through that in a little bit. But you've got to accept some of the equity risk. So you can see correlation with the S&P, which is the first column, is pretty reasonable among most of these names. They're not really diversifiers at this point, even though I think, and this goes back to some of Sal's seasonal charts, certainly during the peak growing seasons in the northern hemisphere, weather is a big driver, and so you can have big moves in grains that are unrelated to anything going on in markets, but still there is a pretty reasonable correlation among this group with the equity market. The other thing, which is somewhat surprising, is if you move further over to the right and get to corn, which is C, so it's that fourth column from the security list. The correlation with corn, and this is a 3-year weekly, you can pick your time frame, but it's actually not that strong, which is surprising because when I think about the drivers of a lot of what's going on in this space, corn is probably the biggest thing. So you can see the correlations are kind of in the 0.05 to 0.5, actually 0.4 range or so. So not highly correlated on a shorter term basis. It used to be that fertilizers, for example, had kind of a 0.75 correlation with corn. That's reduced in the last several years. So it's less a play when you're buying the equities on the actual commodity. The other thing just to note, and people will frequently talk about this, is just the correlation between the dollar and commodities in general. And in this case, if you look at corn and soy, which are 21 and 22 on that list, and move over to the right to the fifth column, which is DXY, that's the dollar index, they are not negatively correlated to the dollar. A weak dollar should be good for commodities. Historically it is, but not negatively correlated. So moving on to the next slide. Again, I mentioned when I look at the equity universe, to me the big driver is corn. This is just a long-term chart, or relatively long, not even that long actually, to give you some perspective. The markets are at relatively, or I would say actually very high price levels. We've been sort of between 5 and 8 over the last year or so. and that creates a really positive environment, I think, for the ag equities. So again, moving to the next slide. This is just the brief overview of what's going on in corn. If you look at the lower left-hand box, crop yield, you can see this is the worst, best over recent period, 5-year average, 154 bushels per acre. 2010, 2011, 148.1 bushels per acre. And so if you actually looked at a long-term trend, this doesn't show it, but generally yields have been getting better. I think technology is a big factor in that. And one of the things that's driven that is increased genetically modified seed usage. You've gone from sort of 25% of the corn crop up to about 80-some. So you're seeing more consistent yields. If you go to the next slide, this is inflation-adjusted farm income, and this is high corn prices and good profitability in corn drive farm income. It's the biggest U.S. crop. And again, I think it's the most important from an ag equity perspective. And so you can see, other than the 70s, this is actually a really long-term chart going back to 1960 or 61. Other than the 70s, this last sort of 5-year period we've been in is probably the best period for the farmer that we've seen. And in particular, this most recent summer is really only rivaled by 04. So it's a good environment for the farmer. They're making a lot of money. They're likely going to spend. And where they're going to spend their money is on the inputs for their crops, so fertilizers, seeds, things like that. And then depending on the cycle, tractors, irrigation, things like that. So the next slide is potash, which is one of those inputs that I talked about. And potash is a fertilizer. You can actually skip the potash application. You can mine the soil, but you can't do it repeatedly. Otherwise, I think you should see a yield degradation. And so this is the last several years in potash we've had some very strong pricing. And actually, this goes back to 08, and you can see demand fell off a cliff. And what the potash producers did was essentially price themselves out of the market. They rose prices too much. Affordability, which is on the next slide, you don't have to go there yet, but affordability dropped. And because the farmer doesn't have to use potash, they boycotted essentially and said, I'm going to mine the soil. And so you had demand go from globally what's normally 55 million tons or so down to 19 million. And so I think we've seen the sort of major skipping that we can see in the short term, and so potash demand should be pretty good, particularly in light of the next slide, which shows global. This is grains and oilseeds, other crops, which would be things like coffee, cocoa, sugar, cotton. And so fertilizer cost relative to crop pricing indicates fertilizer affordability. Farmers have the ability to go out and be aggressive in their fertilizer application. They can pay a little bit more. They can pay for more volume. They don't have to skimp and still generate really high levels of farm income. And so this is a key slide, and it's not just that corn and wheat and soy are at high levels, it's that everything is, and that really helps. And actually, vegetables and fruits are more fertilizer intensive, so generally they're at pretty good levels too, not everything, but so that's another positive when you're looking at the equities in this space. And then the last thing, if you go to the next slide, this is just Potash Corporation's quarterly earnings per share. I showed you potash, the commodity, earlier, and you saw that spike. You can see what their earnings per share did you can see that earnings per share are not quite at those levels, but they've rebounded nicely. And from my perspective, one of the interesting things in grains is, and at Van Eck on the active side, we look at all commodities. And so when we look on the supply side, usually it takes a very long time for pricing or for the supply side to respond. In the case of potash, it can take 7 years. Copper can take 5 years. Permitting of a coal mine can take 3 to 5 years. The supply side in grains can react very quickly. In the span of 6 months or so, you can have a pretty substantial supply side response, both positive and negative, depending on weather. But I think the current situation where supplies are about as tight as they've been in the last 25 years is going to take several years to rectify. And so I think you're going to see, maybe you're not going to see $7 corn or $8 corn consistently, but I think you're probably in an environment where you can be pretty safe in assuming we're above $5 corn. That bodes well for, again, farm income, bodes well for the ability of the farmer to pay for what he needs, and things like potash are one of those things, and I think you should see potash's earnings reflect that and be relatively stable and strong for at least a couple of years here, which I think is somewhat unique in the ag space. I know a lot of people tend to look at this on a very long-term level and say, oh, people have to eat, emerging markets, you're seeing increased standard of living, et cetera. But I think the reality is that in the short term, things can change pretty quickly on the supply side. So I'll leave it at that and turn it over. Is it Dave or Dennis who's up next?
I think Dennis is going to pick it up here for us.
Okay.
Yeah. I'll take it from here, Dave. Thank you. Thank you, Sal and Sam. I think you both laid out the bullish case for agriculture and why having exposure to the sector in a portfolio can make sense to diversify risk and potentially increase returns. My name is Dennis Hudachek, and I'm an ETF analyst here at IndexUniverse. Dave Nadig, our Director of Research, and I are going to walk through some of the ways investors can gain exposure to these themes using ETFs, why choosing ETFs for your commodities exposure makes sense for most investors, and what you should know about these products before diving into them. Probably the first question some investors might be asking is this: why not just invest directly in futures contracts? Well, the short answer is futures are difficult, complicated, and large. You can't buy $5,000 in notional exposure to something in the futures market. Now, you can use $5,000 to get exposure, but because futures are inherently leveraged, $5,000 is likely to get you $50,000 of exposure. You can fully collateralize that leverage by taking the remaining $45,000 and sticking it in T-bills, but you're still buying very large chunks of exposure. Moreover, it can be complicated to manage and one that requires constant maintenance. Every time a futures contract comes due, you have to sell it and invest it next in order to maintain your exposure. Now, most good futures brokers won't let you accidentally take delivery of 1,000 bushels of wheat, but the aftermarket watering holes of New York and Chicago are full of stories of guys who accidentally took delivery of 1 million eggs and have to arrange fire sales in cash markets at huge losses. Now, it's rare, but it's not impossible. Because of these complexities, traditionally most investors have been afraid of jumping directly into buying and selling futures contracts. Trading contracts can get tricky as the expiration dates creep up, and even if I wanted to actually buy 1,000 bushels of wheat, my wife probably won't let me put them in the garage. For those reasons, and the simplicity of being able to trade ETFs in a simple brokerage account, ETFs are continuing to gain a tremendous amount of popularity in the agricultural space. Investors must first choose how they want to gain exposure to the sector. Basically, what type of agriculture ETFs are you looking for? Sal touched up on this a little bit earlier, but investors have a surprising amount of options in the various types of funds that have their own advantages and disadvantages. There are currently 3 different ways to gain exposure to agriculture through ETFs. Futures-based ETFs, where the fund holds and rolls over futures contracts. Futures index-linked exchange-traded notes, where the fund is a debt note that tracks an index composed of futures contracts. And equity ETFs, which hold the actual companies responsible for harvesting and producing agricultural goods. Most exchange-traded products in the agriculture space are structured as exchange-traded notes. There are now 26 ag ETNs compared to only 5 futures holding ETFs, 4 of which are Teucrium funds, and 6 equity ETFs. While the ag space is dominated by ETNs by number of products, by far the most popular fund in the ag space is actually an equity fund, the Market Vectors Agribusiness Fund, symbol MOO, which we'll call MOO. The fund now has over $5 billion in assets under management, which is roughly double the assets of the next biggest fund in the ag space, the PowerShares Deutsche Bank Agriculture Fund. We'll discuss MOO in more detail later on in the webinar when we go over equity ETFs. We'll first start off with futures-based exchange-traded products. We say exchange-traded products, or ETPs, because futures-based funds include both ETFs and ETNs. We'll discuss the structural differences between them a bit later. Investing in futures-based products is more complicated than you might think, especially if you want to invest in a basket as opposed to a single commodity. Before jumping into a fund, there are a couple of questions that potential investors should be asking. For example, in a broad-based fund, which commodities are included in the ETP's underlying index, and how much weighting is given to each commodity? Does the fund buy front-month futures contracts? Or does it follow an optimized strategy where it buys contracts further out on the futures curve to mitigate the effects of contango or even take advantage of backwardation? Or does it use a laddered approach where it just buys a whole bunch of contracts expiring at different months? And finally, how are the various funds structured and what are the credit risks and tax implications associated with these funds? Let's go ahead and dig in. Let's first take a look at the largest ETPs that focus on a basket of broad agricultural commodities. As mentioned earlier, DBA is the second largest ETF in the ag space behind MOO, but it dominates futures-based products and assets and is more than 5 times larger than its closest competitor, RJA. JJG and COW, which we'll call COW, have a narrower scope, with JJG focusing on grains and COW focusing on livestock, while DBA, RJA, and JJA market themselves as broad-based agriculture funds. DBA, RJA, and JJA, 3 broad-based funds, also track very different indexes with different strategies that investors should understand. As you can see, the composition of the 3 largest funds is very different as they track different indexes. Most notably, JJA does not have any exposure to livestock, but instead loads up into only 7 commodities and is highly concentrated in those 7, especially corn and soybeans. DBA and RJA are more comprehensive and have overlapping commodities, but the weighting is different. DBA holds 11 commodities, while RJA gives exposure to 22 commodities, including commodities that DBA doesn't give exposure to, like rice, lumber, rubber, and orange juice. This means that RJA is even more comprehensive in total ag exposure than DBA, and once you move past the top few holdings, you see smaller weightings given to the remaining commodities in RJA compared to DBA. So how did these 3 funds perform relative to each other? Well, over a 3-year period, JJA actually outperformed both RJA and DBA. But even an unsophisticated eye can take a look at the last few months of this chart and see that JJA is more volatile. Just look at that drop this summer when grain prices came down. That extra volatility is because it's not that diversified in its holdings. However, while holdings and weightings are usually the main drivers of returns in plain vanilla equity funds, those aren't the only factors that go into returns when dealing with futures-based products. Futures-based funds also have different investing strategies regarding which contracts it buys on the futures curve that can also impact its returns.
So Dennis, let me take it from here for a few minutes and I'll dig into some of the meat of that. Of those 3 funds that you were just talking about, RJA and JJA are what we would call sort of first generation front month funds, right? This is sort of the simplest approach you can take to the market. You know, they're first generation, they were the first ones that were out, and they have really straightforward strategies that frankly many futures traders have done this for years, and many futures indexes have always been built this way. They just simply buy that front month. When it comes time to expire over some period of days, they roll it into the next one. And as a result, that puts a high turnover cost on that. There's obviously a lot of trading that has to happen, but you also expose yourself directly to the effects of contango. Commodities in contango can result in huge losses. For some commodities, it's essentially perpetual. For others, it's extraordinarily variable and will hit it. Either way, it can be costly. I should stress that contango isn't necessarily an automatic money-losing situation, but it is a headwind if you're investing in a commodity that happens to be in contango when you get in. Funds like DBA, on the other hand, is what we would call a second-generation product. They actually seek to both mitigate contango by picking what you invest in, but also profit from backwardation. So it's not uncommon to have a commodity where you don't have a straight curve one direction or another, but you end up with a bump in it. And by picking where you want to invest on that bump, you can actually make money from this in a commodity that might actually be in contango in the front end of the curve. And finally, there are these strategies, which is sort of an in-between strategy where instead of trying to use an algorithm that's going to pick the best month, which is effectively a form of active management that's just been put into a black box, they basically buy the entire futures curve. They pick a set of months, they have strategies for rolling, and that really works to mitigate that front-month contango issue. This is the kind of strategy that the Teucrium funds or UBS's E-Trax products track. And it has been quite successful. Something like CORN, corn, will hold March, May, July, September, and December. So even if the front month gets pretty deep, you're not completely exposed to that. So why bother going through all this work, right? Why bother making these changes? Dennis, if you can push the slide forward. The reason is that contango isn't static, and it's incredibly important. So here's a sample of the effects of roll yield for sugar and wheat from the weekly contango report over at hardassets.investor.com. In the top chart, you can see that investors in the sugar front month contract did much better than they might have expected. And that's because sugar futures have been, heavily in backwardation. Currently investors are actually getting a positive roll yield or a negative roll cost, depending on which way you want to talk about it, of almost 37%. Now that's not guaranteed by any means, but it's instead of being a head for a sugar investor, it's a huge tailwind. But if you look over at the chart on the right, this is looking at how that roll cost has changed over time. And as you can see, it's gone from contango to backwardation and contango to backwardation, and it's quite variable. So it's definitely a guarantee. If you look at the wheat curve on the bottom, however, you see sort of the exact opposite. You see that steep contango in the left-hand chart where it's going up month after month after month in the futures contract. Last week you were actually looking at 100% implied roll, meaning it was costing you, on average, if you just had this market stay completely flat, you were going to essentially blow through your entire portfolio just on roll costs. Obviously, that doesn't happen, but if you look over at the left-hand chart, you see that wheat's gone from being essentially flat in midsummer to now costing you 6% to roll, month after month. So it's incredibly important to pay attention to this, and it's a significant part of your returns. To put it in context, if we go to the next slide, you can see how this hits commodities overall. This is one of my favorite things that gets published in the space. It's the S&P Monthly Commodities Market Attribute Report. You can just Google that. You'll be able to find it. It's free. And this chart's always in this report, and it shows the front month spot returns versus the total returns of a fully invested front month rolling strategy. So it basically gives you that direct impact of somebody who was a front month roller, what you would think the commodity return actually was. The green bar shows you the spot returns, and the gray bars show you the total returns as what an investor would actually receive for being a holder. And again, in this example, if you look at sugar, which I've outlined in red, spot returns have been close to negative 20% this year, but because sugar spent most of the year in backwardation, the total returns are actually not that far off of flat. By contrast, you look at Live, just two over to the left, and you can see that while spot returns were up well over 10%, taking into account that negative roll yield, you were also essentially just flat. So the real drivers of returns in both these cases have not been the spot prices. They've been just the contango effect, the shape of the market. So the moral of the story here is that when you're investing in futures, you're not just investing in a commodity. You're investing in a market structure. And as an investor, you absolutely have to pay attention to that. So Dennis, I'll kick that back to you.
Okay, thanks, Dave. Now let's take a deeper dive into the other side of investing in commodities with ETFs, equity-based ag ETFs. The equity space is relatively straightforward. These ETFs hold companies engaged in the agriculture space. Now, many investors actually prefer equity-based funds for their simplicity and transparency. For example, equity fund investors don't have to worry about issues that Dave just spoke about regarding contango and backwardation, which can actually be frustrating for the average investor to follow and let alone understand. Now, with equity funds, the major differences that drive returns lies mostly in their underlying holdings or the sector of the agriculture space they target and the size of the companies they hold. This table shows the 5 largest equity funds by assets that target the agriculture space. MU, PAG, and CRBA are all broad-based market cap weighted funds engaged in the entire agriculture space. Meanwhile, crop focuses on small cap companies while soil focuses in fertilizer companies. As you can see, MU is the largest fund by far and trumps all other funds and assets under management. Although it should be also noted that MU, which launched in August of 2007, was the first ETF to enter the agriculture equity space, followed by PAG more than a year later. Crop and soil are also relatively new, having been trading only since March and May of this year, respectively. Now looking at the underlying holdings of the 3 largest equity funds, as you can see, MU and PAG hold an array of some of the largest and most well-known companies engaged in agriculture, including big names such as Monsanto, Potash, Mosaic, and Archer Daniels in their top holdings. All the companies that overlap between MU and PAG are highlighted in brown. In contrast, crop, which focuses on small cap company, has completely different holdings from MU and PAG. Now, being that MU and PAG have so many overlapping companies in their top holdings and even share very similar weightings for these overlapping holdings, we would actually expect the 2 funds to perform relatively in line with each other. Now, here's a 1-year returns chart for MU and PAG, and as we expected, the 2 performed closely in line with each other during this 1-year period, with MU slightly outperforming PAG by returning negative 5.4% versus negative 6.5%. But, I mean, in general, the 2 funds had a correlation of 0.97 over the past year. But what about the correlation between equity ag funds and the broad equity market? Now, this is something that Sam had touched up on earlier, but taking a look at the correlations table once again over the past year, you can clearly see that MU has a much higher correlation of the broad market as measured by SPY, the Spider S&P 500 ETF, than both DBA and RJA, which are the 2 largest futures-based funds that we discussed earlier. MU currently has a correlation of 0.89 versus SPY. Now, in contrast, DBA's correlation with SPY is 0.51, while RJA's is 0.42. Therefore, with MU having a higher correlation to SPY, MU can be much more susceptible and vulnerable to broad market sell-offs like we saw this past summer. Now, that can be a good thing or it can be a bad thing. And here we go. When charting these 3 funds against SPY from July 1st of this year, when a lot of the volatility began, you can clearly see that DBA and RJA held up relatively well in early August as SPY and MU plunged almost 15%. Now, this obviously doesn't necessarily mean that DBA and RJA will always outperform MU when the broad markets fall. It just means that since MU is an equity-based fund, it'll usually be more vulnerable to swings in the broad equity markets compared to both DBA and RJA. On the flip side, if investors gain confidence in equities, you'd expect MU to ride the tide of investor enthusiasm in addition to experiencing any effects of being in the commodities business. So while investors might choose equity funds for their relative structural simplicity compared to futures-based products, equity funds also have their drawbacks. For investors looking to invest in the ag space strictly for purposes of diversification and less correlation in the broad markets, DBA and RJA may actually fit that purpose better than a fund like MU.
So I'll take it from here, Dennis. You know, I think just one or two things we wanted to hit before we move on to get a lot of questions coming in already. If you have any more, feel free to fire them in. I think it's worth pointing out a few of these structural and tax differences because a little bit like Contango, they can actually be far more important to your actual after-tax portfolio returns than you might expect. Go ahead and flip over to the next slide there. You know, as we've said, there are these basic different structures here. We've got open-ended funds, commodities pools, and exchange-traded notes. Just very briefly, you know, the equities funds obviously are very straightforward. It's just like investing in SPY. You're dealing with, you know, known risks. The wrappers are generally 1940 Act mutual fund wrappers. You've got a board of directors. It's a very straightforward, familiar for most investors. There's still ETFs. You still have to worry about your trading. You have to worry about premiums and discounts. You still need to pay attention, but they are essentially very straightforward products most investors are familiar with. The futures-based ETPs, on the other, are structured as commodities pools or exchange-traded notes. And the commodities pools it's simply a different structure. You know, we had a disclosure slide at the beginning. There's a reason they had to put that up, right? It's 1930X or 33X different. It has different, you know, tax ramifications. And the exchange-traded notes, you know, these are debt, and it's important that investors recognize they are debt. You know, sometimes it's very obvious, like iPath ETNs products are very clearly taking the credit Barclays Bank. It's all very clearly disclosed. You know, the power shares of Deutsche Bank ETNs are backed by Deutsche Bank. It's pretty straightforward. Some of the ETNs, it's not nearly so clear. For instance, the Rogers Elements ETNs, like RJA, which we've been talking about, is issued by Merrill Lynch. Sometimes it can actually be a little tough to realize that it's not Merrill Lynch on the hook. It's actually Bank of America. And even for, or it's not Bank of America, it's actually the Swedish Export Corporation. Now, whether or not you're willing to take the risk of owning a debt note from the Swedish Export Credit Corporation, which is certainly quite a large financial institution, is your call. And our general opinion is that the actual default risk on ETNs is quite low, but it's definitely not zero. And investors need to know that they are taking that little bit of extra counterparty risk. And lastly, there are some tax issues. If you want to flip over to the last slide here. You know, the equity-based funds, very straightforward. You're getting the same basic, you know, 1535 long-term, short-term capital gains ratio rates that you would expect any of your equity investments. You're going to get a 1099 at the end of the year, pretty straightforward. On the right-hand side of the chart, the ETNs live in a little bit of limbo. You know, for the most part, with very few exceptions and some currency products, all ETNs are currently treated essentially the same way as equity funds. You're going to pay a long and short-term capital gain off a 1099, like if you invested you know, in a traditional piece of fixed income or a traditional mutual fund. However, there is some uncertainty whether the IRS will continue to allow that tax treatment. That's sort of a default treatment. They've never come out and said this is actually how this should be. It's simply how it's being done by, you know, generally accepted principles from you know, CPAs preparing investor tax returns. But that doesn't mean it couldn't change. In the middle, you have what could be a good thing or a bad thing, depending on how you look at it. The commodities pools are all taxed as limited partnerships by the IRS, and they're essentially being treated as if you were a futures investor directly. And what that means is that your portfolio gets marked to market at the end of every year, and you pay a blended tax rate, 60% long-term, 40% short-term. That comes out to about 23%. Now that's, if you were somebody who would otherwise be trading quite a bit, this could actually be a much better tax rate than you'd be paying. If you were actually planning on holding this for the next 5 years, this might be a higher tax rate than you'd otherwise be paying. Mark-to-market issue is often new for some investors. You'll get a K1 statement, not a 1099. And that K1 is basically going to give you your allocation from the partnership of your gains, which have been marked to market, whether you sold it or not. So you could be invested in one of these funds. It could have a great year. You could get essentially a tax bill despite not having actually sold your investments. Just something to know before you go in. Let's go to the last slide here, and with that, I'll point out that I'm not Matt Hogan on the slide. I'm actually Dave Nadig on the upper right-hand corner. Let's open up the conversation to our speakers, Sal and Sam. It's great having you guys here. Sal, maybe we'll get started with you. you know, from one of your earlier slides, you seem to be saying that that investors should allocate a sort of certain portion of their portfolio to commodities, that there sort of should be sort of an accepted norm, a little bit like the 60-40, you know, equity bond split that people often talk about. What percentage of the average investor's portfolio do you think should be allocated to commodities overall, agriculture in specific? I mean, is there academic justification for a real number there?
Well, there's clearly academic justification for inclusion in the portfolio. And again, we're sponsors, we're not advisors, so I couldn't make a specific recommendation other than to say that there's clear proof, and it's widely accepted, that commodities in a portfolio benefit that portfolio. And if you're using commodities, like we say, everybody overweights energies. What they just don't think about enough is the ag side. And there's true stress on the ag side that didn't come before. I think Sam's didn't exist before. Sam's chart about corn there, he had a 5-year chart of corn up earlier. That was wonderful to see the volatility there. And again, there's danger and opportunity in that volatility, but the bottom line is something I didn't mention is every 3 to 7 years, one of the big 4 crops had some issue in production. And that's why you see these big spikes, 2 of them in corn in the past 5 years. And they're so dramatic that the returns can indeed be quite extraordinary. So can the losses. Again, you got to be careful, and that's why these are alpha products. The fact that Teucrium's lucky to have 4 of the 5 futures-based products out there, but we're very specific. So we're not blended. We're corn fund, a sugar fund, a bean fund, and a wheat fund. You can overweight or underweight to your liking, and you really do need to be looking at the ag part of your portfolio.
Right, and part of that, part of what that speaks to is that these can be quite volatile, right? I mean, you definitely can see these markets where you see corn drop 35% in a fairly, what in the equity space would be a fairly short period of time. If there's a bad crop report or something like that. I mean, Sam, turning to there is this sort of trade-off between the buying the milk versus buying the cow strategy. Do you get any insulation from those sort of short-term shocks? And what other kinds of risks are you either mitigating or exposing yourself to? I mean, one thing we were talking about earlier was the currency issue. I mean, are you disparately affected by the U.S. dollar if you're, say, investing in the commodities versus investing in, say, a Canadian potash company?
It depends. Obviously, a Canadian potash company, if you're buying the equity in Canada, you're taking on some currency risk, and that can have different effects depending, obviously, on which way it's going. With regard to the risks you're taking on, obviously there's equity beta in the equities. One of the things it obviously, and Sal's pointed this out, it depends on the product you're investing in, and you guys did as well, but roll yield can be a big thing. So as long as you understand that, that's one side on the commodity, or one thing on the commodity side with equities. Ideally, you can find companies where, depending on the product, they're growing earnings and growing production, and so that over a longer period of time, you can somewhat remove the commodity from the equity, meaning if you get a potash producer that's going from 1 million to 10 million tons over 5 years, that earnings growth hopefully should mitigate commodity price moves over that long period. The question is whether most people are willing to sit through that. They all pointed out there can be quite a bit of volatility in all these spaces. So it really just depends. But certainly when you're buying the equities, you're assuming, I think one of the tricky things is multiple risks. You're assuming equity risk. You're assuming the underlying corn, wheat, or soy risk, and then whatever that product is they're selling. So if it's fertilizer, that's another commodity that has its own supply and demand dynamics. So
right.
Sal, sorry, David, did you want to go ahead, or? I just had a quick question for Sal, actually. Sure. Sal, I just want to touch up a little bit on what Dave had talked about a little earlier regarding volatility. Now, back in 2008, agriculture, along with most other commodities, got hit extremely hard. Now, if you even look at futures-based products like DBA and RJA during that time period, a lot of these funds actually fell just as hard as the broad markets did. Now, I know that today we got some good news out of Europe, but should another global financial crisis hit again, I guess my concern is a lot of people invest in these futures-based products for diversification purposes because they're uncorrelated with the markets, but I guess has anything changed since 2008 that might make us believe that these ags will actually hold up better this time around compared to 2008, or has it actually gotten worse? Like if there's another financial crisis, are these going to get hit even harder than they did in 2008?
I think that's a supply-demand picture individual to the commodity. So, you know, if you look at August, which was a terrible month for stocks, this past August, corn actually was up double digits. I think it was up 12 or 13%. So, you know, what's changed for 2008? I'm going to let Sam answer that one actually. But I think whether it correlates or not, Sam's data has shown that corn correlates the least of all the things he threw up there, if I'm remembering correctly. So, yeah, these things are, you know, good for beta diversification. But again, you know, there's good alpha product out there, and whether they correlate or not is going to depend on whether it's a complete crisis or not. And again, energies, you know, people will be cold and hungry. That's the last thing they'll let themselves do. So that's our opinion on that.
Yeah, I can just add in. Do you want me to follow up on that? Or?
Yeah, please. I was just going to ask you. I mean, the other thing I'd ask you to maybe speak about is, you know, we talked a bit about the China effect here. You know, what if China has a hard landing in all this?
Yeah, I mean, certainly. Look, over shorter periods, and Sal pointed this out with August, it's a good example, and particularly in that sort of prime growing season in the northern hemisphere and in the southern hemisphere too. It's more an impact on soybeans, but weather and individual sort of supply-demand dynamics can really drive things regardless of what's going on in financial markets. Those are short periods of time, though. I think, you know, with the financial crisis, with the way things are shaping up in financial markets, when you do have these sort of tail risk type events, and they're less and less about the tail now, that they seem to happen more often, but correlations go to 1, and there really aren't many things you can diversify with. I mean, even gold, which should be a diversifier in most environments, was pretty highly correlated through this last 3 months or so, and you know, there's a bunch of studies that have gone around recently. If you look at the GSCI, which is not a perfect index, a lot of energy, roll yield, etc. But if you look at the GSCI relative to the S&P, it's as highly correlated as it's ever been. If you look at even the individual stock market, I know we're trying to talk about commodities, but the median 63-day correlation of S&P 500 stocks to the index is as high. It's the only other time it even got close to this level was in 87 during the crash. It's never been this high. So everything is very correlated, even if there are underlying supply-demand dynamics that can influence something over a shorter period. Right now, I think hopefully we decouple, but right now things are pretty correlated, unfortunately.
Yeah, for sure. We have a couple of what I would call sort of foundational questions, and I'll sort of roll them all into one. And maybe I'll start with you on this one, Sal. You know, I mean, we have a lot of folks who are fundamentally sort of stock and bond investors looking at commodities for the first time. And if you look at the returns of stocks and bonds, your expected return can at least be culled down. Bonds going to pay a coupon. The stocks traditionally are going to pay a dividend, and that's kind of what drives the expected positive return of them as investments. With commodities, you know, why should an investor expect a positive return above the level of global inflation out of corn or soybeans or, you know, oil or anything else in the commodity sphere? I mean, Sal, you want to tackle that one? It's kind of a thorny one.
It is thorny, but you know, the bottom line is commodities are supply-demand. That's why they're so volatile. They react more to supply-demand. You know, stocks have management risk, securities have management risk, event risk. Commodities are supply-demand driven. It's fairly easy to see, and so investors can see the cycles. They're extremely cyclical, especially the grains, which, you know, have these supply patterns that are very well defined. So to expect a positive return over time, you know, you take little pieces of it, as Sam says. On a short-term basis, as you look at things, do your supply-demand analysis, you can overweight or underweight, again, the alpha portion of this presentation to do that. But in terms of a buy and hold, it's much more of a beta strategy. I'm not so sure people are looking for positive returns as more negative correlation with the rest of their portfolio. And again, the empirical studies over time prove that. One thing I might add is I was visiting some advisors up in New Hampshire not long ago, and they were using these commodity-based ETPs because, again, a lot of advisors are looking at commodities. They have no futures experience. So these commodity-based ETPs are really, really good because they, in essence, are used as a futures replication strategy. Very easy for an advisor to do that. But they were writing calls whenever they felt that one of these ETPs was getting to the point where they wanted to sell it but didn't want to lose the diversification. They were writing calls, and they were calling it basically a return. They were calling it like a dividend. It's not the way to look at it. It's a covered call strategy, but that's something people can employ. These products are really valuable to investors and advisors.
I think maybe we're already running about 5 or 10 minutes over, but maybe we'll just sort of wrap up with sort of one follow-up to you on this. You know, for investors that are used to looking at, you know, the underlying business of something like, say, a tech stock, are there different things you need to look at when you're evaluating, you know, the equity side of commodities here? I mean, do investors need to start paying attention to crop reports and you know, what the weather's doing in Iowa, or do sort of traditional equity analysis techniques really just work the same?
I think it's a combination.
Yeah, I agree with Sam.
Yeah, I mean, it's definitely, you know, on a shorter-term basis, the movements of corn can really matter, and if over longer-term periods, corn's highly correlated with a lot of these agribusiness names. In the shorter term, you know, it definitely is an impact over longer term as well. Though, you know, you can see the individual fundamentals and drivers of you know, an agribusiness company act the same way as they would for any company. So it's, you know, how they're allocating capital, what sort of returns they're getting on their investments, et cetera.
Makes sense. Well, thank you guys very much. I have a feeling we probably could have spent another hour about this. It's a big topic to try to cram into an hour and 10 minutes here. For folks who had questions that weren't able to get answered, we'll send you over to one of our 3 websites. Hopefully the answers will be there. You can try to follow up with one of us directly. If you've missed some portion of this or you'd like to rewatch it, it should be available on our website shortly. And we'll be in touch with folks who've been watching this live for information on applying for CE credits if that's something you're interested in. We hope you'll join us for another issue of our Alpha Beta webinar series at a future event. Thank you very much.